2024. I think we started the point that we are going to have rate cuts that will be delayed rather than being front-loaded. So the market was looking at first rate cuts coming in the second quarter, probably mini pricing May, and we're calling for July. Since then, what we have changed now is that we have kicked out our first rate cut to perhaps September, particularly on domestic inflation concerns, and then secondly on global environment concerns as well.
So given the data that we've received domestically, I mean, what overall aggregate picture do you get about the South African economy?
I think the economy is coming back from low growth level. Last year we had about 0.6% growth in 2023, partly driven by the excessive power cuts that we experienced. This year looks better. We are looking at growth around 1.3%, being uplifted by less power cuts and I think more work perhaps on the logistics sector side. And we are also expecting that rate cuts would kick in and also help with consumption. You may have noticed that last year we had household consumption spending contracting in real terms in the second quarter and the third quarter, which was primarily culminating in the peak level of interest rates. I think the last hikes were in May last year, and we are looking for that pivot towards cutting. So perhaps this year still looks better, but in domestic inflation is still being sticky, which means that we probably delay the rate cutting cycle until inflation is perhaps well below 5% that the SAB would start being comfortable with.
Speaking of sticky inflation, I mean, we got that US CPI figure, and I'm curious to hear your thoughts on that.
Look, I think on the US, inflation yesterday came slightly higher than expectations, which would probably mean that there are still debates about whether the US will start cutting from June or they'll push out further cuts. So our house view is that the Fed would probably start to cut from June. So if there are reasons to delay the rate cutting cycle on the US side, it would also filter through onto the South Africa side. It is difficult to see, I think, the SAB starting to cut well before the US starts cutting. And then secondly, on the domestic inflation side as well, which has seemed sticky, so 5.6% print from last month is a difficult concept to be discussing cuts. So perhaps it is probably more holding. So we do expect that when we get to the May MPC, which is a day after the elections, we still expect to see unanimous hold, though start to have dissent votes for others calling for cuts, perhaps in the second half of the year, which would be from July, and materialize perhaps thereafter.
Speaking of the Fed, I mean, coming into 2024, there were some analysts who were pricing in probably 6 or 7 rate cuts, and it's quite interesting to see how that repricing has changed. In fact, some are even saying perhaps we might not see a cut at all, given the figure we got yesterday. What would that implication be for the SAB if we didn't see a rate cut from the Fed at all this year?
Yeah, look, I think U.S. data has come stronger than expected. The economy still is strong, the labor market is still strong, and the dollar is still strong. So that is perhaps why the Fed is still waiting to probably cut on weakness on some of these variables. So if in the case that we don't see cuts from the US side, then it means the dollar remains strong and probably the rand remains weak or on the back foot. So one of the arguments that we point towards inflation coming closer to the target is also that the rand is likely to strengthen on dollar weakness. So delayed dollar weakness also means that inflation may not pan out as we perceive, and perhaps that translates into SAB delaying cuts, at least until we see more rate cuts coming through on the global side, and particularly from the Fed. So delays from the Fed means no action from the SAB at least.
Let's do an economics 101 here, and perhaps you can school us. I mean, how hard is this part of the rate cycle when it comes to bringing inflation back to target? Is there a textbook example? Have we been here before, or is this slightly tricky for central banks?
I think the central banks, particularly on the global side, they've probably done well in bringing inflation closer to the target. So we're now looking at inflation around the 3% level compared to, say, levels that were above 5 to 7% in many ways. But the expectation here was that when you bring down inflation, it is going to come at a cost. And the cost one was probably recession, and that has not materialized. But now you're in a situation where inflation has sort of come down somewhat, but the economy is not weak, which is the conundrum, I think, that the central banks, particularly on the global side and specifically on the US, that they are still going through. So it's difficult to be cutting rates when the labor market is still strong and the economy is still growing. So I think that's perhaps where we're coming from. So you need to see something cracking a little bit, particularly on the economy side, for the central bank to start cutting and to stimulate that economy. So that's the conundrum where we are.